welcome to AM Best's 2025 Reinsurance Market Briefing.
We're here in sunny Monte Carlo for the Rendez-Vous de Septembre, where the great and the good of the reinsurance industry are gathered. This year there seems to be some disagreement as to exactly where we are in the reinsurance cycle. AM Best gave its view at its annual reinsurance briefing.
So over the past 12 months, developments have largely aligned with our expectations as we laid out at last year's Monte Carlo presentation, as you can see on the slide. Underwriting profits continue to be strong, although off 2023 levels. We saw modest declines in risk-adjusted pricing on property cat covers, but that was driven by account performance, layer, and geography. Risk selection and overall pricing remain discerning. Terms and conditions and attachment points remain largely stable. We've seen inflationary pressures and interest rates moderate somewhat over the last 12 months, but as we'll get into, there's a significant amount of uncertainty around both, given geopolitical and macroeconomic uncertainties. We expect reinsurers to remain disciplined in risk selection, structure, and pricing entering 2026. Despite significant insured cat losses and man-made losses in the first half of 2025, the segment is set to record another strong year, and results should exceed, definitely well above pre-2023 levels.
For 2024, what we can say is that the dedicated reinsurance capital is at its highest for the past 12 years. Not just that, each portion of that bar is also at its highest and has surpassed its previous records. Traditional reinsurance capital has grown steadily, in particular the last 2 years, owing to strong underwriting results, higher interest rates, and pricing disciplines. We do expect 2025 to end up at an all-time high for the ILS capital. We are also seeing a push to make ILS more of a mainstream asset class. Attempts have already been made to open up the pool of investors to, let's say, smaller institutional and even retail investors. We have also seen an increased interest in collateralized reinsurance deals, particularly over the last 12 months, as these deals can cover risks that are not commonly securitized by cat bonds.
Our expectations over the next 12 months are a bit more muted or cautious than they were at this time last year, just given the transitioning nature of the property cat market. With all that being said, we do expect operating results to remain strong and well in excess of cost of capital in 2026. Although we expect greater differentiation in rates and pricing, that will be dictated by that discernment in terms of performance of the cedant and layers of risk being placed. We do expect terms and conditions and attachment points to remain largely in line with what we're seeing currently. We expect the flow of funds into the segment to continue to be driven by strong retained earnings, as well as what looks like it's going to be another robust year of cat bond issuances in 2026.
If now is not a positive market, when is? I think, apart from the last 2 years, reinsurers would rather be operating in today's environment than anything in the past 12, 15 years.
For AM Best TV, I'm Richard Banks.